Welcome to Talking Markets with Franklin Templeton. I'm your host, John Chigutsky, from the Global Marketing Organization here at Franklin Templeton. Today, I am joined in the studio by Ben Barber, Head of Municipal Bonds at Franklin Templeton Fixed Income. Franklin Templeton Fixed Income, otherwise known as FTFI, is one of the largest municipal bond managers in the United States and has been managing tax-free income strategies for over 40 years. The team is comprised of fixed income specialists with a measured, no surprises approach. FTFI is committed to pursuing consistent, resilient, fixed income results for clients with the outcomes they expect. Ben, welcome to the show.
Thanks very much, John. Appreciate being here.
Ben, I've been looking forward to our conversation focused on the municipal bond landscape and your unique insights on several topics that most investors may not be aware of when it comes to investing in muni bonds. As a professional in the muni bonds market for over 30 years, what are the biggest changes that you've seen in over 3 decades?
Okay, well, first of all, that makes me sound really old. I don't really feel that old, but we'll go with it. I think there have been significant changes, of course, over the last 30 years. And I sort of look back on my career and think about it in a couple different pieces. One is certainly the pre-2008 world, and the other being the post-2008 world. And so I would say the first answer to the question would be certainly the market has changed dramatically. In 2008, the real shift that took place in our market was due to the insurers, the monoline insurance companies that had typically wrapped about 2/3 of the municipal market, all lost their AAA status in different portions of 2008. At the beginning of 2008, the downgrades of the monoline insurance companies began, and they continued through 2008, and some went out of business, some formed the good bank, bad bank, but the change to the insurance company ratings in 2008 dramatically changed the municipal market. As I said, about 2/3 of the municipal market was AAA by virtue of these insurance wraps prior to 2008. And when the downgrades started, that amount of the market that was AAA went from about 2/3 down to about 15% of the municipal market. So roughly from 60% down to about 10 to 15% was AAA. And the big implication of that is the municipal market became less efficient. It became less correlated to the treasury market, as the market really needed to recalibrate and have pricing based on the underlying value of the bonds as opposed to the value of the insurance wrap as a AAA provider. And so that shift in 2008 was just a tectonic shift in the municipal market, and it really changed things quite a bit. And one of the main things that was a result of that massive movement from largely AAA to a minority AAA in the municipal market was the lower correlation to treasuries, because what that really didn't allow anymore was a very easy and efficient way to hedge municipal duration. And the impact of all that, of course, was that the broker-dealers became much less enthused to own large chunks of municipal bond inventory, even at the very high-grade level, because that hedge just didn't work that well anymore. The correlation between high-grade munis and treasuries, as it broke down, that hedge became less and less valuable. And so therefore, you had the dealer community much less willing to stock bonds, and the liquidity of the market by virtue of that really came down quite a bit. I think that one shift to the municipal market back in 2008 really made professional investing, as we do here at Franklin Templeton, it made professional investing in the municipal market much more interesting, because the asset class became much more opportunistic, much less efficient. And so for professional investors such as ourselves, the market became a lot more interesting and a lot more fun to operate in. For long-term investors, this is a really good result for the municipal market, because you're ostensibly buying an asset class that is too cheap relative to its credit fundamental, very high credit fundamentals that we have in the municipal market. So I look at that change in 2008 as being just a massive difference. I would say, a second change in our market over my career has certainly been the improvements in technology. And the municipal market is very large. It's roughly 4 trillion of overall market cap. People talk about 1 million different CUSIPs, and that's true. There are over 1 million different individual CUSIP line items out there. Over 50,000 different issuers. So it's a very large market, but it's very fragmented. And so to keep it all in check and to keep it organized, to keep your views on the credit fundamentals of all the different credits and credit sectors out there is a huge challenge. And technological advancements have made that much easier over time. And I would say the other big deal with technology changes over time is the ability to trade much more efficiently, right? Just setting up algorithms that can help you slice and dice the market quite a bit better, figuring out price discovery in the market quite a bit better. These have all been really big improvements in the municipal market and enables us as large institutional managers to be able to manage munis in all of the different formats in a really efficient way. So I'd say, the technological changes have been another big difference over my career. And the last thing I would point to would be the changes in ownership and sort of the changes in where money is flowing into or out of the municipal market over time. And this was really accelerated in 2022. If you'll remember, that was the year where rates really increased quite a bit. There were record redemptions out of open-end municipal bond mutual funds, but very interestingly, there were very positive flows into muni separately managed accounts, SMAs. And so that shift that had been taking place for quite some time really did accelerate in 2022 with the big outflows out of open-end funds into SMAs. And that continues today. Flows have definitely stabilized and have returned to positive in the open-end fund world, but not nearly to the degree that was, lost in 2022. And meanwhile, the SMA flows have been increasingly positive year over year. So that's been a pretty interesting dynamic. And the reason I bring that up is because those changes in flows really from open ends over into SMAs, it's actually had an impact on the market. It's had an impact on the shape of our yield curve, and it's had an impact on credit spreads. And thinking that through a little bit, SMA investors tend to be very high quality investors, looking at the highest portions of the quality spectrum in the municipal market. And they also tend to be a little bit shorter on the yield curve. They tend to be sort of intermediate and shorter type of durations that SMA investors will typically go after, as opposed to open-end funds. The bulk of the assets there tend to be longer out on the curve, and they can tend to also hold a little bit more credit risk in those funds because yield is such an important portion of what sells open-end mutual funds. So as that money has flowed from sort of longer duration down the credit spectrum types of investments into shorter on the curve and higher quality investments, that's impacted both the yield curve and the credit spread environment in our market. Again, when we think about the results of this, I think this is a good result for long-term investors. It's creating more yield out the curve. It's creating more yield as you go down the credit spectrum and sort of fits perfectly into the managed products that I think can be really appealing for many investors. So those would be some of the major changes, John, I think, over the last 20, 30 years of my career that have made the muni market what it is today.
It really sounds like three massive changes, but there's still a tremendous opportunity to be found in the municipal bond market. With that being stated, what are the misconceptions or maybe misunderstandings that people have in general about the space that you've come across?
Yeah, I think it's a great question. There are several misconceptions about the municipal market. And again, I think these are all good to have these misconceptions because it keeps the asset class maybe a little bit cheaper than it ordinarily would be. I think one misconception is that munis move exactly in lockstep with treasuries. And of course, they don't. They'll generally follow the same sort of trend. If rates and treasuries are going higher, for a long period of time, or if they're going lower for a long period of time, Of course, munis will follow along with that directionally, but they certainly don't move tick for tick and even day over day or week over week. And that creates opportunity when the valuations between munis and treasuries change quite a bit. It provides opportunities for different investor bases to come into the municipal market sometimes if munis get particularly cheap relative to treasuries. Sometimes we can have crossover buyers, buyers that would typically buy taxable fixed income investments that could cross over into the tax exempt space because they find it particularly attractive. And that can happen from time to time. So I think that's one of the misconceptions with regard to the muni market is that it moves in lockstep with the treasury market. It really does not. And I think when it does not, that is certainly, one of the times where you can pick up really good opportunities in the municipal market. I think a second misconception about the municipal market is what is risk in the municipal market. And I think a lot of people think about risk in overall fixed income markets or most securities as some sort of a risk to principal. In other words, a default risk. And I think that the misconception is that that's really the only risk with regard to munis is the bond going to default. And as we know, for those of us who have been in the municipal market a long time, default percentages are quite low in the municipal market overall, especially in the investment grade world. But they do happen, and you've got to be prepared for that and make sure you're in the right investments, of course. But one of the misconceptions is that risk really only comes in the form of default. And I would say that risk comes in the form of default for sure, but it also very importantly comes in the form of liquidity. Liquidity is always difficult in the municipal market. I like to say it's always difficult, and sometimes it's extremely difficult in the municipal market. Again, this is one of those things that it sounds scary, but it's really one of the really nice attributes to the municipal market that provides the opportunity for quite a bit of yield, especially on a taxable equivalent basis for investors that are long-term in nature. So thinking about risk in the municipal market, I think it's very, very wise to think about the liquidity risk that we have in the municipal market. We spend much of our time here on the Franklin Templeton municipal bond team thinking about the liquidity in the market and what is a good portion of liquidity from the yield curve perspective and the credit spectrum perspective. Thinking about across the country, is liquidity better in certain states or certain sectors rather than others? And we spend a lot of time thinking about liquidity. It is, I'd say, one of the most important, if not the most important risk that we have in the municipal market. And of course, when you think about risk, you're also thinking about opportunity. And so I would say that's a really, really big one. Is liquidity is probably your biggest risk. It's also your single biggest portion of opportunity that we have in the municipal market. The third misconception that I would highlight in the municipal market is thinking about the construct of the rating spectrum in municipals. There are the rating agencies like S&P or Moody's or Fitch that will put ratings on many of the municipal bonds out there. And they start at AAA and they go to AA and single A and then triple B. And then once you get below that, that's the below investment grade world. And the reality is in the municipal market, many of those bonds are rated. Many of the bonds come as non-rated. So S&P, Moody's, Fitch is not asked to put a rating on many municipal bonds. And there are several different reasons why. I think the genesis of that is that a lot of municipal bond offerings tend to be quite small, and the cost to get a rating could be prohibitive for a small or maybe a one-time issuer in the municipal market. And so as a result, a big municipal bond portfolio management team like ours would always have a lot of research analysts who are very well versed in looking at deals in which there's no rating. Again, this is another really unique attribute to the municipal market, quite different than the taxable fixed income markets in that there are quite a few sectors and many bonds that come to the market as non-rated bonds. And as a result, because you cannot rely on an outside rating agency to rate the bonds and have an opinion, as a result, they tend to come cheaper. So you pick up more credit spread, more yield for those non-rated bonds. I think the misconception that I'd like to highlight would be non-rated doesn't necessarily mean junk bonds or below investment grade or high yield in nature. A lot of the non-rated bonds in our market are actually very solid credit. And when we buy a non-rated bond here on behalf of any of our portfolios, we're required to have our own internal rating on there that would be pari passu to, how a rating agency would view the credit. And, many times on a non-rated bond, we'll be in the investment grade space in that triple B or single A or even double A type of category for non-rated bonds. So that's another misconception in the municipal market, is that non-rated bonds doesn't necessarily mean junk or below investment grade bonds. They can be perfectly fine investment grade quality type bonds. They just don't have a rating by an outside rating agency, which again can be one of those attributes that can provide very good opportunities in the municipal market.
Very, very interesting. So in that answer, you mentioned your team 2 or 3 times. I'm thinking about the transition and all the change and evolution that has occurred in the market in your time in the municipal bond market. And I'm wondering how your team has evolved over that period of time to address the opportunity. Is there anything that you could share there?
Yeah, it's interesting. When I think about what has changed on our team, the first thing I go do is what has not changed. And what has not changed is very, very strong, focused on research. The research analysts in our group are required to analyze the financials, of course, but you're also analyzing demographics and demographic trends, and you're analyzing political structure and who do we think is going to be the next party in power, for example, at the state legislature, the state gubernatorial race, and that sort of thing. So there's all sorts of research that needs to take place, and that has not changed over the decades that I've been in this market. But I think a couple things that really have changed, the risk management evolution has been just fantastic from my perspective. Very typical for a large asset management shop like Franklin to have a risk management group that looks over each asset class and reports to the C-suite of the firm, whether that's to the CIO or COO, maybe it's the CFO or CEO. And that's a very typical structure for a large asset management group. And we have that, of course. But in addition, we have an internal risk management function that we have embedded here in the municipal team. This person sits on our desk, is very much part of the entire portfolio construction process. And the tools that we can utilize now are so far superior, to what we had 10, 15, certainly 20, 30 years ago. It's really been a welcome addition to a portfolio management team like ours. And so the risk management evolution is something I'm really, really happy about, really proud about here at Franklin. And it enables us to slice and dice the portfolios exactly as we want and really see where risk and opportunities are coming from in all portions of the portfolio, whether it's yield curve or coupon structuring or optionality, the call optionality of bonds or sectors or individual, idiosyncratic type risk, et cetera. And so the tools that we have now at our disposal have evolved quite a bit. And so I love that about the change, certainly of our team over the years. I'd say the other significant change to how our team operates is really the trading framework. The challenge here is how to make an incredibly disjointed, fragmented market much more organized and efficient, right? And that's especially important with the massive growth in the separately managed accounts, where you as a large manager are not going to have a couple dozen accounts. You're going to have hundreds, if not thousands, tens of thousands of accounts. And how can you keep that all organized in the context of a market that, as we said earlier, has 50,000 plus issuers and 1 million different CUSIPs? It's very difficult. And so the trading framework is critical. Obviously, the technological advancements that we've had have been really, really helpful over the years. The algorithms and the electronic trading that can help us slice and dice the market, help on price discovery. These tools can be very, very helpful, for a large shop like ours, managing across, different platforms of open ends and SMAs, ETFs, closed-end funds, all the different formats that we manage munis in.
So you just mentioned the new vehicles that are available for investors to use investing in municipal bonds. Are there additional impacts to those changes, opportunities, risks associated with exchange traded funds or separately managed accounts?
Yeah, I'd say first, it's all about investor choice, right? We're committed to offering our capabilities across all the vehicles to be able to provide for all investors. From our perspective, we've managed up and down the yield curve, very, very short, very long. We've managed up and down the entire credit spectrum, as well as national diversification. But being able to offer all of those capabilities across the different formats is really critical for our investor base. With regard to ETFs, I'd say the growth up until now has really been in the passive world, and a slight problem with that in that they tend to be fairly restrictive in terms of their investment profile. They tend to have customized benchmarks that exclude large portions of the muni market. And our view is that the beauty of the muni market is really how large, but also how fragmented and inefficient it is. So many of the best values in our market could very well be in the portions that are excluded by the more passive muni ETFs. So, we definitely favor having less restrictive, more active muni ETFs that can take advantage of all the unique inefficiencies in the muni market. So that's the idea on the ETF side. On the SMA, with regard to SMA investing, demand is very, very strong and has been for several years. And as I said before, it accelerated in 2022 with a lot of muni money moving from open ends over to SMA. So strong, in fact, that, as I said, it's been impacting the market from two perspectives, from both the yield curve and credit spreads. With regard to SMAs, I think that the demand will continue to be quite strong. Investor preference is showing up that way. And I think the level of customization that I know we can get to for clients has been very, very attractive for a lot of the investors out there. And so I would anticipate that demand in SMAs to continue. The interesting thing with regard to SMAs will they continue to evolve in terms of their level of sophistication? As I said before, most of the SMA demand has been in the form of intermediate and shorter and very high credit quality. And so the question is, will SMA investing continue to evolve down the credit spectrum, out the credit curve, out the yield curve, to provide more opportunities for investors? I think the answer there is absolutely yes. We're definitely on the forefront of that. And I feel really good about the different offerings that we have, for example, in the SMA space.
So Ben, as we look to close today's Talking Markets conversation, you've talked a lot about change and evolution in the municipal bond space. You've talked about great opportunity and why that opportunity exists. Is there a final takeaway that you would like to leave our listeners with as it pertains to the municipal bond market?
Well, I think that the municipal market has matured in certain ways, certainly with regard to technology and product availability, but it also continues to be very inefficient, and it tends to be very opportunistic for long-term investors. And so that's the overall takeaway. What I love about how we're set up at Franklin Templeton, I really appreciate that we have the capabilities that we have, but also the investor choice that we have through open-end mutual funds, through ETFs, SMAs, a couple of closed-end funds, to be able to tap into our resources and our capability and our entire team here at Franklin Templeton. And it allows us to be at the forefront of all that change and innovation.
Ben, thank you for your time and your very valuable insight today. To all of our listeners, thank you for spending your valuable time with us for today's exciting and informative update. If you'd like to hear more Talking Markets with Franklin Templeton, please visit our archive of previous episodes and subscribe on Apple Podcasts, Google Podcasts, Spotify, or just about any major podcast provider.
This material reflects the analysis and opinions of the speakers as of August 4th, 2025, and may differ from the opinions of portfolio managers, investment teams, or platforms at Franklin Templeton. It is intended to be of general interest only and should not be construed as individual investment advice or a recommendation or solicitation to buy, sell, or hold any security or to adopt any investment strategy. It does not constitute legal or tax advice. The views expressed are those of the speakers, and the comments, opinions, and analyses are rendered as of the date of this podcast and may change without notice. The information provided in this material is not intended as a complete analysis of every material fact regarding any country, region, market, industry, security, or strategy. Statements of fact are from sources considered reliable, but no representation or warranty is made as to their completeness or accuracy. What are the risks? All investments involve risks, including possible loss of principal. Fixed income securities involve interest rate, credit, inflation, and reinvestment risks, and possible loss of principal. As interest rates rise, the value of fixed income securities falls. Low-rated, high-yield bonds are subject to greater price volatility, illiquidity, and possibility of default. Liquidity risk exists when securities or other investments become more difficult to sell or are unable to be sold at the price at which they have been valued. Active management does not ensure gains or protect against market declines. Treasuries, if held to maturity, offer a fixed rate of return and fixed principal value. Their interest payments and principal are guaranteed. ETFs trade like stocks, fluctuate in market value, and may trade above or below the ETF's net asset value. Brokerage commissions and ETF expenses will reduce returns. ETF shares may be bought or sold throughout the day at their market price on the exchange on which they are listed. However, there can be no guarantee that an active trading market for ETF shares will be developed or maintained, or that their listing will continue or remain unchanged. While the shares of ETFs are tradable on secondary markets, they may not readily trade in all market conditions and may trade at significant discounts in periods of market stress. There is no assurance that any estimate, forecast, or projection will be realized. Funds, ETFs, and separately managed accounts, SMAs, offer different choices to access professional investment management, but have important differences, including with respect to fees, ownership structure, investment minimums, customization, and tax efficiency. Account minimums and other requirements may apply for separately managed accounts. Investors cannot invest directly in an index, and unmanaged index returns do not reflect any fees, expenses, or sales charges. Past performance does not guarantee future results. Data from third-party sources may have been used in the preparation of this material, and Franklin Templeton, FT, has not independently verified, validated, or audited such data. FT accepts no liability whatsoever for any loss arising from use of this information, and reliance upon the comments, opinions, and analyses in the material is at the sole discretion of the user. Products, services, and information may not be available in all jurisdictions and are offered outside the U.S. by other FT affiliates and or their distributors as local laws and regulation permits. Please consult your own financial professional or Franklin Templeton institutional contact for further information on availability of products and services in your jurisdiction. Issued in the U.S. by Franklin Templeton, 1 Franklin Parkway, San Mateo, California, 94403-1906. 800 dial Ben, 342-5236. FranklinTempleton.com. Investments are not FDIC insured, may lose value, and are not bank guaranteed. Issued by Franklin Templeton outside of the U.S. Please visit www.franklinresources.com to be directed to your local Franklin Templeton website. Copyright 2025 Franklin Templeton. All rights reserved. Podcast theme music by Adam Badofsky.